Mixed-use property questions are really classification questions. First, are you renting only part of your home, like a room? Or is it a vacation home you sometimes rent and sometimes use personally? Or is it a below-market rental to family, meaning no profit motive? On the EA exam, the right tax treatment usually falls out once you label it correctly. If you rent out part of your home, you treat it like two separate units, rental and personal. Direct expenses for the rental area are fully deductible on Schedule E. Shared expenses, like utilities or insurance, must be allocated. The two common allocation methods are number of rooms or square footage. The exam loves a quick square footage ratio. Here's the classic pattern. One bedroom is rented, the rest is personal. If the rented room is 10% of the home square footage, then only 10% of heat, insurance, and similar whole house costs go to Schedule E. But if you repaint only the rented room, that's a direct rental expense, so it's 100% deductible. Direct versus shared is the key distinction. For vacation homes and other mixed personal and rental use, you next ask, does personal use make it a residence? The residence test is personal use more than the greater of 14 days or 10% of the days rented at fair rental value. If it's a residence and expenses exceed rental income, the loss can't offset other income. Excess carries forward and can only help that property later. Now contrast that with a not-for-profit rental, usually a below-market rental to a relative. If there's no profit motive, you don't get to create a rental loss. The income is still taxable, but it's not treated as a normal Schedule E rental. And unused expenses don't carry forward. Mortgage interest and property taxes may still be deductible on Schedule A if the taxpayer itemizes. Finally, the 15-day rule is the weird one they love to test. If you rent a home that's otherwise a residence for fewer than 15 days during the year, you exclude the rental income entirely, but you also deduct zero rental expenses. It's all or nothing. So 14 days or less. No income, no rental deductions. Hit 15 days and you're back in the normal rules. Derek works full-time as a lifeguard. He's also a competitive surfer and has entered competitions for 6 years, intending to earn prize winnings. He puts significant time into it and keeps good records of income and expenses, but he has not yet earned a profit. As his tax preparer, what would you advise? Hobby treatment with taxable income and no expense deduction, or treat it as a business, or ignore it, or defer the expenses? Think about it. The best answer is that Derek is likely engaging in a hobby. The income is taxable, and the expenses are not deductible under current rules. The tempting wrong answer is calling it a business because he keeps records and has a profit intent. But the long history of no profit pushes it toward not-for-profit activity on exam questions, which means no expense deductions. Ethan bought a home for $250,000, allocated $50,000 to land and $200,000 to the house. He later added a bathroom for $18,000. He moved out and converted it to a rental. At conversion, the house FMV was $245,000 and land was $65,000. After renting it out, he paid $2,400 for plumbing repairs. What basis is used to calculate depreciation during the rental period? Think about it. The answer is $218,000. For a personal home converted to rental, depreciable basis is the lesser of adjusted basis or FMV at conversion, and you use building only, not land. The house adjusted basis is $200,000 plus $18,000 or $218,000, which is less than the $245,000 house FMV. The $2,400 repair is deductible, not added to depreciation basis.